The cryptocurrency market continues to tremble. Terra's catastrophe is generating a feeling of extreme fear, although the price of Bitcoin sits in the $30,000 zone. In the weekly time frame, we can see the volatility generated in the market this week. The price of Bitcoin lost the zone between $33,000 and $34,000. With Fibonacci's extension carried out from March 2020 and foreseen until the next cycle, the $69,000 zone, we can see that the $33,000 to $34,000 zone marked the realized price by whales. In other words, the average price at which whales purchased Bitcoin. And that zone between $33,000 and $34,000 converges with Fibonacci's extension 0.50. The week of May 8th, we saw a pretty volatile movement as the previous lows were broken. The following week, an important volume input was seen as well as a continuation movement toward the downside. In addition, the price once again broke the critical support zone between $27,700 and $30,000, reaching $25,300. With the deployed averages, we can see the crossing of the 20 and 50 period moving averages in the week starting March 21st. In the previous analysis, we can see that beyond the 0.50 Fibonacci support mentioned earlier, that zone started to converge with the 100 period moving average. When the price closed below that average in the week starting May 2nd, it represented a bearish continuation movement, and we're already in the 7th bearish weekly candlestick. Now we're seeing buying interest in this candlestick because, as mentioned, the price has rejected the $27,000 zone, which could result in an inverted hammer candlestick. In the daily time frame, we can observe a pattern forming between January to March, an ascending parallel channel. What we can see is a continuation pattern where a distribution zone has been forming, one that could be compared to a wick-off distribution. When this type of formation occurs in a downtrend, the chances of this moving continuing to head towards the downside are greater than the chance of bullish movements. If we deploy the averages in the daily time frame, we can see that the price has lost all averages. The zone around the end of April attempted to resist the $37,000 to $38,000 zone, but once we lost that zone with a volume increase, in other words, harmony between effort and result, which is a third Wyckoff law, we saw a continuation movement and headed on to test the $33,000 zone, that incredibly important whale zone. However, a series of news stories pushed the price down. Between $27,700 and $29,000, it coincided with July's 2021 lows. It was a crucial zone, although the candlestick of May 12th even reached $25,340 zone, creating a significant hammer candlestick with a small body and a massive spike, revealing buying interest in the zone. When the $38,000 zone was lost, we mentioned that if the 36.6 points were to be lost in the Relative Strength Index, or RSI, a bearish movement could be carried out, disconfirming the divergence seen in the indicator. Now, if we zoom in on this indicator, we can see that a small divergence between May 9th and 12th is forming, which will be confirmed if it does not lose the 25.17 point zone and if the price continues dropping. This would warn us of a possible movement reversal. In addition, this composite indicator between oscillators is a sign of overselling, where we're starting to see a crossing which in the short term indicates a change in direction, although it has not yet been confirmed. And the stochastic also indicates an overselling zone where these lines cross each other. We're also seeing harmony between effort and result. To break the $33,000 to $34,000 zone, a significant volume input has been carried out, in other words, the third Wyckoff law. The macroeconomy and the foreign exchange market have an increasingly close relationship with the cryptocurrency market. So let's see what's happening with the dollar and traditional markets. In this dollar chart, we can see that it has reached an incredibly high rate compared to other currencies such as euro, yen, British pound sterling, Canadian dollar, Swedish krona, and Swiss franc. The dollar's value has broken 2016's zone of highs, but take a look at the RSI, which is found in an overbought zone, although at the moment there are no divergences that could warn us of a potential trend reversal. As we'll see shortly, the sale of government bonds and company shares could be leading investors to take refuge in the dollar and therefore boost its value. In the SP 500 chart, once the zone of lows in March 2022 was lost, we saw a bearish continuation movement, leading it to 3.8090 points. Yesterday, a hammer candlestick formed, displaying rejection, which could indicate a movement reversal. We'll have to wait and see whether it is able to consolidate that zone to attempt the movement reversal. A chart we must also pay attention to is that of the 10-year US government bond yields, where we can see a downtrend. In other words, the result of buying United States government bonds. As we can see, the downtrend kicked off in 1981 and it's never been broken until now, where we'll have to see whether it is a fake out or a rupture is consolidated. What does this indicate? That there's always been a relative interest in buying those US debt securities, which is why the yield has been falling. Since June 2020, we've seen a progressive sale of those bonds. One of the reasons behind this is the Fed's announcement of this balance sheet reduction, a balance sheet made up of, amongst other assets, mortgage bonds and government debt, among which are 10-year bonds. When there's a fall in the SP 500 index, usually bonds are bought to take refuge from volatility. However, in this case, dollars are being accumulated as seen previously. Why? Because the Fed has threatened to increase interest rates, which would make borrowing more expensive, which is why they're getting ahead of themselves and accumulating dollars instead of bonds. And of course, if there is no interest in buying those bonds, their yield increases, supply and demand. But let's take a look at the overall feeling in the market. The Fear and Greed Index reveals that the cryptocurrency market is in a state of extreme fear. One of the factors that has generated this fear, as you know, is the news around the Luna project's catastrophe, which we've explained in this video here. But let's move on to the macroeconomic analysis to better understand the market situation. The Consumer Price Index in the United States has dropped slightly, something which initially could be seen as good news. But since it is a higher figure than expected, investors have not taken it well, given it is still very high and stands at 8.3% in April. This could be the first positive consequence of the Fed raising interest rates, although as we have seen, the SP 500 has been affected. Let's not forget that the rise in interest rates is a double-edged sword. It could reduce inflation rates, however, it could halt economic growth. But this is just one of the many factors influenced the market. Coinbase, the leading cryptocurrency exchange, announced the company's revenue in the first quarter, which did not meet expectations as the fall in the cryptocurrency market has weighed down on its growth. In this chart, we can see that the earnings per action have fallen to minus $1.98 per action. Revenue has dropped to $1.7 billion. In a week where stablecoins are being scrutinized, USDT, the Tether stablecoin, has also lost parity against the dollar. The fear around stablecoins as a consequence of Luna slump has caused the disassociation between USDT and the dollar. The CEO of Tether reminds us that Tether continues to process conversions and stablecoins continue to generate sufficient trust. Now, let's move on to the Onchain Analysis to examine the blockchain data. Over the last few days, we have seen an input of Bitcoins in exchanges, which is normal if we take into account that the market is in a moment of sales and Bitcoin holders are placing their cryptocurrencies in exchange wallets to put them into circulation. Even so, for now, we're still in a downtrend, which means that investors continue to hold their Bitcoins in cold wallets. On the other hand, wallets with over 1 billion Bitcoins have also reduced their balance over the last few days, although retail investors, for instance, have accumulated Bitcoin over the last few days. One of the factors that has pushed the price of Bitcoin down is that traders in futures market leveraged again. The funding rate turned positive, meaning the financing rate that is used to maintain the correlation between the spot market price and the futures price. When positioned positive, longs pay shorts and vice versa. This resulted in the huge liquidation of futures traders over the last few days. Just on May 9th, 261 billion bitcoins in long positions were liquidated once it broke the $33,000 to $34,000 zone on the downside. This added to what we saw in the previous analysis, where we commented that short-term holders have been able to sell at losses as a result of fear and inexperience is likely to have caused the price to drop. This could represent a capitulation of Bitcoin holders who've just entered the market due to that extreme fear that we previously mentioned. The funds have also been reducing their exposure between April and May, but could now start accumulating once again. In this chart, we can see moments of Bitcoin's accumulation and sale on behalf of miners, which indicates that miners could be capitulating, in other words, selling their Bitcoins despite the price being low and the price of energy increasing. And now let's move on to the volume profile, which we must not confuse with the climatic volume, represents the volume of a specific candlestick. However, this volume profile represents the volume of a specific price zone. As we can see, the $40,000 zone has a buying and selling interest, similar to the $27,000 zone, a zone that the price of Bitcoin has just touched. In this chart, we can see that the price of Bitcoin has crossed the realized price by whales on the downside. The realized price is the average purchase price of unused Bitcoins. In this image, we can see various elements. On one hand is the MVRV, which indicates the market value to realized value, the division between the price of Bitcoin and the realized value. This indicator is used to determine whether Bitcoin is over or undervalued. Overvalued if it is over 3.7 and undervalued if it is under 1. If we take a look, the price has already touched the realized price zone of the portfolios that have between 100 and 1,000 Bitcoins. In short, Bitcoin has been on a downward slope for weeks, and the cryptocurrency market remains in a state of extreme fear. Fear caused by Terra's chaos. The price of Bitcoin therefore attempts to hold still and sits at $30,000.